Good morning, hello and welcome to Trading Hour. It is 11 a.m. and the story on the street is that the Nifty is not quite trading above the 23,000 mark, but there's recovery from lows and large caps are beginning to see some buying. We have some healthcare stocks doing well, some life insurance stocks doing well, and even mid caps, they are now off the lowest point of the morning. I'm Surabhi Upadhyay, as always on the show with me, Reema Tendulkar. Hi, Reema.
Hi, Surabhi. Afternoon. Mid caps are trailing a bit, right?
Not yet afternoon. Almost.
Good morning. Mid caps are trailing a bit, right? The mid cap index is in the red. The small cap index is a cut of close to about 0.5%. The advanced decline ratio, pull that up. The advanced decline ratio is down close to about 2 stocks gaining for 3 in the red. So the advanced decline ratio is firmly in favor of the losing side. Asia this morning is also fairly range bound, but holding out with a positive buy. So whether it's Hang Seng, Taiwan, Straits, most of them have a green tick going for themselves. But I think we can characterize this market as so far quiet, ranged, but with a bit of a positive buy. So waiting and watching. I think 5 days to go now for the election verdict.
Imagine it's just getting closer and closer, right? All of it, this volatility, this rise in the VIX, and then the recovery, and then the all-time highs, all of it boiling down to the 4th of June. So yes, we're getting very, very close to the event. Today, of course, it's a lot about individual stocks, whether it's earnings reactions or some corporate developments or block deals for that matter. So let's just quickly dive right in and tell you about the movers and shakers of the day. Some of the names in focus are PB Fintech and Concord Biotech. These are stocks under pressure. Timken India, however, has been surging in trade, and that's because of a block that happened early in the morning. Vivek is joining in with the lowdown on all of these stocks which are on the move today. Vivek, morning.
Well, good morning. What's actually happened is that as we are nearing the end of the earnings season, a lot of the block deals, remember, now the promoter entities are free to sell, and which is why you're seeing all of these blocks come back into the market. So, you mentioned 3 names, let's go through each one of them one by one. First one is PB Fintech. You saw a large block deal, a little over 1% of equity changed hands over there. Tencent Cloud Europe, an entity that held a little over 6.2% stake in the company, sold their stake. They sold close to 1.2% stake in the company, so they continue to hold around 5% stake in the company. On the back of that, you're seeing the stock down by almost 3%. Once again, worries of an overhang exist as part of the remainder of the stake. Now, the next stock on the radar that you mentioned was Timken India. Timken India, remember, earlier also in June 2023, you saw the promoter entity, that is Timken Singapore, sell a significant stake. In fact, that time they had sold almost 10% stake at 3,000 rupees a share, after which they had around 57.7% stake. Today, there has been a stake sale of another 6.6% stake, and after today's block deal, the promoter shareholding comes down to 51.1. So now if they sell further, there is a chance that, the simple majority shareholding that they have could come down, and most of the analysts on the street believe that this could be the end as far as paring down of the stake by the parent is concerned. On the back of that, on the back of this particular perceived relief, you are seeing the stock higher significantly in the trade today. Lastly, Concord Biotech, another block deal over here, almost 3.5% of the total equity changed hands. Ontario Inc. was the seller in this particular block deal. 1320 was where the floor price was for this particular deal. And again, there will be a residual 2% stake, so that will be another overhang as far as Concord Biotech is concerned.
Thank you very much for that. These are the big block deals in focus. Let's invite a market guest on the show, Anirudh Garg, Partner Fund Manager at Inva Asset PMS, to discuss some of the market trends that we're observing in the run-up to the election verdict. Thank you very much, Anirudh, for joining in. First, just give us your sense of the market, how we are positioned in anticipation of the election verdict, and what's the best way now, if to make money. If someone has cash, what should they do?
Thank you for having me. I think we have to look at it from a broader point of view. The last 2 years, we have seen a tremendous rally happen in the mid caps, small caps, and especially the PSU and the capex sectors. These are the sectors that are leading the run, while we have seen that the larger heavyweights like private sector banks and information technology rather, underperforming. I think the trend should continue from here, but in an expensive market as we currently are, one should balance the portfolio well. So you need to buy both growth and quality, so that in case there comes a fall post-election or before election, I don't know when the fall will come, you are balanced. Your portfolio does not fall too much. And when it comes to growth, of course, the sectors that are leading the run, they have maximum relative change behind them. And that is the reason they should continue their, the run forward. So optimal combination of both.
So where is it that would you recommend booking profits perhaps in stocks which have run up quite a bit like defense, railways, or since that's been the government thrust, it's best to keep riding it?
See, it is not just about the government coming in that these stocks are rising. There is actual relative change happening behind them. Just see what is the government capex. We are at 11,11,000 crores, which is almost 5 times what it had been, 10 years before. So we have to focus on the fact that these are wonderful companies. These are the sectors that India needs. They are the sectors that are shooting out. Whenever the sector that shoots out primarily, it starts looking expensive because of the relative change and the run that it has had. The price expansion has happened. The earning expansion is still to happen. So these are very good companies for the next 2 to 3 years, I suppose. So if somebody is holding them, I would recommend not to sell them. They should be the leaders according to us for the next 2 years as well. While just jumping into them when some euphoria, some extraordinary volatility or extraordinary interest is being created in the market may not be that prudent. So yes, add them on dips is what I would suggest rather than booking profits.
Okay, so stick to the theme. The theme is still working. Buy the dip. Got it, Anirudh. So that's your strategy. I believe you're also optimistic on real estate and, similar situation here where stock prices have really run up. And of course, we know that launches are still happening and pricing is moving higher. But how should one approach real estate given the run up? And again, if you break it down in terms of developers or geographies, then, what would you be more comfortable with? Though, I mean, even as I asked that question, most developers are now going pan-India, getting into each other's territories. But still, what's the approach to real estate?
See, we have to recognize that this is an old economy run. This is focusing on value and the commodity prices. After the US Fed has said that the inflation is not a problem anymore, should do well. Now, when we talk about the interest rate sensitives in the last couple of years have performed very badly, only rising after the US Fed said that there is no problem anymore. Now, I believe that the international interest rate sensitives, I'm just talking about the entire interest rate sensitive theme, should do well. Metals primarily should be the winners of the pack. Now, when it comes to domestic interest rate sensitives like real estate and autos, we believe real estate should do particularly well because real estate can pass on the increase in commodity prices to their customers pretty well. And what real estate can pass that is the luxury real estate. So luxury real estate part for us should do primarily well, and that we are seeing all over India. You can see DLF launching a project starting at 7 crores in Gurgaon, being sold out within a day. Similar, it is happening for other quality developers. I believe that the trend should continue. When it comes to autos, I believe that they will not be able to pass on the increase in commodity prices from here, and they are at an expensive valuation. So I've tried to answer all the three in one question.
Okay, so not that bullish on auto anymore. Anirudh, a lot of investors have been betting on Nifty ETFs. But your view is that the Nifty is not capturing India as it is today. The Nifty constituents represent India's old economy, while it's the new economy stocks which are thriving right now, and that's not captured in the index. So what would your advice be for someone who wants to buy a Nifty ETF or has been investing in it? Because according to you, it has limited significance now, the Nifty constituents.
Okay, so let me just rephrase that a bit. Maybe when I sent you my thing. So what I believe is that the last run, which started from 2010 to 2020, had a major effect on the Nifty constituents. We saw a lot of new economy come in. So if you see Nifty, 33%, around 30 to 35% of the Nifty is, private sector banks, and the rest 30 to 35% is new economy in terms of IT, pharmaceuticals and stuff. So Nifty is today majorly denoted by very quality companies like Dow Jones is. So 66%, 2/3 of the Nifty is new economy quality companies, while only 1/3 or less than 1/3 is left for the old economy and the value oriented sectors. This is an old economy run. We can see all capex, interest rate sensitives, metals, real estate, all these sectors doing pretty well. And I believe that the trend should continue. The only, the only hope and the only support that I find in Nifty is to provide the balance to your portfolio in an expensive market. Otherwise, Nifty is totally an FII's game right now. They are the ones holding it, while the DIs are holding the old economy and generating alpha for their clients. So yes, Nifty today is representing new economy more rather than old economy, which is leading the run right now.
Where do you stand on banks? In the last 4 years, banks have underperformed the Nifty, barring, I think, 1 year in 2022, when it significantly outperformed the index. But other than that, banks have been underperforming the Nifty, despite the fact that now perhaps valuations are looking attractive. And there was this argument made, right, that if India has to grow, if the Indian economy has to thrive, then banks will do well. It's a safe bet. But it's not that banks have performed very well. So considering that it's such a large constituent of our markets in the index, where do you stand on banks?
See, markets, we believe they totally believe in relativity. Banks are the best bets for India, yes. But are their valuations supporting that bet? I believe no. Private sector banks, which are very good lenders in India, were given a valuation that was nowhere in the world. 2 years before, I remember Kotak and HDFC Bank at valuations that were not seen anywhere with the financial companies in the world. See, a stock at 6 price to book, what else do you expect, which has led the run for the last 10 years? I do not expect it to run for another 10 years. We have to segregate banks. The banks which were considered not worthy to invest in, the public sector banks, they had maximum relative change behind them. You saw the NCLT laws come in, you saw government, capitalizing them, and the sectors that they lend to primarily, like metals, real estate, etc., doing pretty well. Old economy sectors doing pretty well. So the relativity made sure that the money would flow to public sector banks rather than private sector banks. And the public sector banks did well from there. If you look at the last 2 years, public sector banks have done better than the Nifty and much better than the private sector banks. So I believe here also the trend should continue. There is still a lot of scope for us according to the relative change in the public sector banks.
Anirudh, great conversation. Thank you very much for joining in. Look forward to chatting with you more frequently. Get into a break. We'll come back and discuss commodities. Manisha Gupta joins in as always. Welcome back. As promised, let's talk commodities. Manisha is now joining in, and she's going to be focusing on the revised wastage and input-output norms for gold, silver, and jewelry exports. Manisha, please explain it to us.
Oh, well, yes. This is quite interesting, and almost everybody buys jewelry, and there are a lot of listed companies as well. So this is quite an interesting one that comes in from DGFT, and pretty much on expected lines on this one. So, wastage is something that jewelers do tend to charge to their customers right now, and it is a part of their profit. And every jeweler does put it as a different calculation in sense of wastage. So until now, for gold, silver, and platinum, when it comes to the weightage of it, the DGFT has amended it this and tightened it, by the way. So if you're looking at plain gold or plain platinum, plain silver jewelry, earlier the wastage that was allowed was 2.5%. Now that has been cut to 0.5%. So if you are buying 10 grams of jewelry, let's say, it is earlier the jeweler could charge you 2.5% of wastage on this 10 grams. Now they can charge only 0.5% on that. And if you were buying studded jewelry or for gold, silver and platinum, again, the wastage that the jeweler could charge you was 5%. Now it's less than a percentage point. Same goes for the gold and metals and coins as well, medallions, etc. So earlier it was 0.2%. Now the wastage that they can calculate and charge you is 0.1%. So that's pretty interesting now, because it is disappointing clearly for the smaller jewelers, but for a consumer point of view, this is quite on the positive side. The other thing that the DGFT has come out in sense of a notification is about specification of the precious metal that is exported, and in lieu of that, what you are importing, that in turn also has to be given quite clearly. So there are some gaps or some loopholes that the industry had earlier, and the higher wastage norm that they were working with, that clearly seems to have ended right now.
Thank you, Manisha, for that. We will slip into a break on that note. On the other side, we'll invite a corporate on trading, our Ganesha Ecosphere, to discuss the company's Q4 earnings and the way forward. Stay tuned. Welcome back. Let's invite the management of Ganesha Ecosphere on the company. This is a company which recycles your plastic PET bottles into polyester fiber or polyester yarn, which is a variety of applications, very versatile applications in textiles, etc. So that's what the company does. They reported their Q4 numbers, and on a year-on-year basis, we've seen the company's top line grow by 1.3%, while margins too have expanded. So from 11.2%, margins now stand at 15.4%. So more than a 400 basis points margin expansion. We have with us Gopal Agarwal, the CFO of the company, to take a few questions for us. Thank you very much, sir, for joining in. While on a quarter-on-quarter basis, we've seen a decent revenue growth of more than 7%, on a year-on-year basis, your top-line growth is only at 1.3%. And even for the full year, in FY24, you've clocked in a top-line decline. So first, if you could tell us what led to the weakness in FY24, because of which the company's top-line degrew, and also the way forward, because you are talking about growth in the coming year, FY25. So are we looking at a single-digit kind of growth, or do you think you can accelerate to a double-digit growth?
In our legacy business, where we are manufacturing the recycled PSF and recycled yarn, so there the prices has come down by about 15%. So there is no volume degrowth, but because of the price sliding, our turnover has come down. But for our Warangal unit in our subsidiary has been started and the revenue has started from October 23 onwards. And so we are, for FY25, we are looking for a growth of about 50% in top line and bottom line.
Sorry, 15% in top line and bottom line, right?
50-60% growth in top line and bottom line.
50 to 60% growth in top line and bottom line in FY25. So you spoke about how your legacy business is under pressure. So just for our viewers, what percentage of your overall revenues or top line comes from the legacy business, and your new business, what are the key drivers?
So for FY25, our new business will contribute about 60% in the about 50% in the sales and 50% from the legacy business.
And,
okay, got that. And what's the difference in the growth that you anticipate for legacy business and your new business in FY25 to arrive at this 50-60% growth?
The growth will come from the new business.
So will legacy decline?
So yeah, legacy will remain at about 900 to 950 crore.
And Mr. Agarwal, for the benefit of our viewers, can you just describe the segments that go in legacy business and the ones that you describe as new business for you?
So new business, until we are into the textile business, we are making the recycled PSF and recycled yarn in our legacy business. Now we have turned to the repackaging business, where we are making the food grade recycled granules which are used in making the beverages packaging.
Okay, so you're saying that you will see a top line growth of 50% this year, and the new business will see an uptake and it will drive that growth. Can you give us some idea about volumes and also pricing in both the businesses, the old and the new, and how that's moving, what your expectations are for this year?
So the pricing is about 15 to 20% higher in new business.
Okay, and this is, as in you're talking about FY24, Q4, or over what period is this higher by 15 to 20%?
Yeah, so we are talking about the present Q4, from Q4. The Q4, the average realization of our legacy business and the new business is about 15-20% higher pricing we are getting in the packaging business.
Okay, so what's the difference in your margins for the legacy versus the new business?
So from our new unit in South India, in Warangal, the overall EBITDA margins we are looking for about 24%.
In the new business, your margins are 24%.
24%. In our legacy business, we are making the margins about 11% plus.
Okay, so midway between the two should be your margins for, so 17-18% could be the margins for FY25 on a blended basis?
It would be around 16% around.
15 to 16%.
Okay. What about expansion of capacities? I mean, how much capex are you putting to work this year? And just give us an update on cash levels in the company and debt levels as well, if any.
Yeah, so we are already having capacity of 28,000 tons for our rPET granules, which we are increasing to 42,000 ton in the current financial year. And after that, we are also planning to make some expansions in the capacities, but that are yet to be finalized. And we will come back with the whenever it will be finalized.
Okay. Sir, I remember in an old conversation you'd spoken about even a QIP to fund your capex. So are you looking at any fundraising initiatives?
No. We have recently raised the funds through QIP. We are not going for raising any fund to equity market in near future.
Oh. Okay. And how are exports doing for you?
Sorry?
Exports.
Yeah. We are making export about 11% of our total revenue.
And are you looking to scale that up? How is the overseas market for you in terms of demand?
We are looking for good business opportunities in Indian market itself, domestic market. So we are not focusing on the export market.
Got it. So if 3 years down the line, so this year, perhaps your top line growth will be about 1,600, 1,700 crore rupees. Given the way business is shaping up, your capex plans, which are, the capacity expansion which is coming up, can you give us some 3-year picture for the company? How would it look like if we talk to you, about FY27?
Yeah, so for next 3 to 5 years, we are looking for a top line growth of about 25 to 30%.
25 to 30% CAGR.
Yeah, CAGR.
Okay, and how would the mix of the company change?
So our focus is now on the new business. So our capacity enhancement would come in new businesses only.
Got that. And will there be a further improvement in margins? Or 15 to 16% is it in the next 3 to 5 years?
Yeah, our margins will be around that.
Got that. Are you looking at any acquisitions, or will there be any efforts on that front?
Yeah, we will be taking it whenever an opportunity comes to us.
Got it. Thank you. Thank you, sir, for joining in. That's Ganesha Ecosphere telling us what happened in FY24, how the legacy business is witnessing some pricing pressure. So the company's top line de-grew last year, but the company is going to bounce back. 50 to 60% is going to be the revenue growth in FY25. But over the next 3 to 5 years, the company is targeting a top line growth of 25 to 30%, on a CAGR basis. Get into a break. On the other side, we'll invite Jay Thakkar of ICICI Securities to take a few trading questions.
Welcome back. Today is a good day for a couple of life insurance stocks, and HDFC Life would be one example, because despite the fact that it's a sluggish day so far, this is a stock that's holding up well. It's building on some some gains as we are seeing things. And even SBI Life, for that matter, 2 life insurance stocks that are doing really well. Let me just check LIC. LIC came out with numbers, but LIC isn't doing much. LIC is flat, actually slightly lower. So it's the private life insurance stocks that seem to be better off. Otherwise, the mid-cap market is again, feeling the heat, feeling the pressure, because the mid-cap index is again falling. If you see the intraday chart, there was a recovery just around the time when we started trading hour, but now again, there's a bit of a dip coming in at the index level as far as the broader market is concerned. Well, let's move on and say hi to Jay Thakkar. He's joining in to help us with some trading ideas and some advice on the index levels as well. Jay, good to have you on the show. So how's it looking? Getting closer and closer to the big event. Any index trades at all?
Hi, good morning to you, Surbhi and Rima. Absolutely, there has been a good breakout on the index. About 22,800 on Nifty. It was looking quite likely that it will range towards 23,000 to 23,200 range. And yesterday we saw it, it climbed to the levels of 23,110, and from there we saw some profit booking, and that is likely to happen because the India VIX is going up, day on day, and it's already at 24. It can reach to 25, 28 levels as well prior to the, exit polls, or maybe the final outcome of the general election. So that can happen, but then overall, Surbhi, I would say that 22,800 to 750 is a very crucial support range for the index, and any dips towards 22,900 would be a good risk reward. So buy on dips around 22,900. One can place a stop loss below 22,800. Thereafter, again, target 23,100 to 200 on the upside. I think that prior to the general elections outcome, it's 22,800 to 23,200. That's the 400 points range within which Nifty can trade. As far as Bank Nifty is concerned, there is 48,750 to say 50,000. That's the range, within which I would say that Bank Nifty is likely to trade with, and I think that around 49,000 would be a good entry point for Bank Nifty as well. I have two buy recommendations for me. Both are from the financial space. The first one is on the HDFC AMC. The stock is trading around the levels of say 4,000, in the spot. One can buy this, placing a stop loss at 39.20, and one can target 41.50 to 4200 in the very near term. The stock has provided a breakout from a sideways consolidation. The momentum is also back into the buy mode. The second buy recommendation is on Muthoot Finance. It's trading around the levels of 1700. One can place a stop loss at 1650. Target 1770 to 1800. The stock has been in a good uptrend. The momentum is back. And I think, we are seeing a good long additions in both of these stocks as well. So Muthoot Finance and HDFC AMC, these are the two buy recommendations apart from the index heavyweights, which I had recommended earlier.
Okay, by the way, some PSUs are correcting now, PSU banks in particular. The Nifty PSU banking index is down 1%, and there has been a sharp turn in sentiment there, not the private bank, the PSU banks. And pull up something like a State Bank of India or even a Bank of Baroda. Bank of Baroda is now down close to about 1.5%. That's a slide that you can see in the PSU banks. But thank you very much for joining in. We will slip into a very short break. But before that, here's a quick small programming note for all our viewers. Join us live on the 31st of May from 5:30 p.m. onwards for CNBC TV 18's Future Female Forward. The Leadership Circle, a transformative platform where leaders from diverse fields will venture beyond the traditional discourse and share stories of grit and determination and roads less traveled. This Leadership Circle is not just about business strategies and professional accolades. It's about delving into the depths of personal journeys these trailblazers have had. Welcome back. United Spirits is up 1.5% after the management spoke about a double-digit growth in FY25, though back-ended. Mangalam is now joining in with the details of the Q4 numbers, the outlook for FY25, and what brokerages have made of it. Mangalam.
Well, if you look at the conference call commentary of United Spirits, it tells you that there is some moderation in demand, especially at the lower end of their overall portfolio, and that's largely because of the consumer wallets which have taken a bit of a hit over the last couple of years, largely because of the inflation. But that trend is unperturbed in the premium end of things. In fact, in premiumization, the trend is intact, and not just that, they're guiding for double-digit volume growth in prestige and above volume. So this year, more importantly, the revenues of the company should also grow in double digits, and that's largely likely to be back-ended because the next couple of quarters, there might be some demand moderation. Having said that, the good part is that there hasn't been any big impact on demand on account of elections yet. And in light of that, the raw material situation also is seeing some moderation. But while that is happening, will the EBITDA margins expand this year? Yes. Will they expand as much as they did last year? Perhaps not, because the last year they had to, undo 2 years of problems, and they did that in 1 year itself. And they actually did better than what they had guided for earlier and what the street was expecting. So they don't expect that sort of EBITDA margin performance to come by in this financial year itself. And as a result of all of this, brokerages, while they're largely positive, they've also exercised some caution on account of the valuations that the company trades at. So we start with Macquarie, which has raised about 7% in form of their estimates for FY25 and FY26. But at the same time, ICICI Direct has ICICI Securities has left their estimates unchanged, but they have a target of 1,200 rupees on the stock. JP Morgan on the other side says that while the numbers are good, the medium-term upside is all captured in the current valuations, and as a result of which they retain underperform. So positive commentary coming in from the management with some moderation, and that's exactly how the stock is trading as well. Positive, but only so much.
Got it, Mangalam. Thanks very much. It's had an interesting journey, United Spirits. Let's pull up a one-year chart. high, but maybe not high enough compared to some of the other big movers and shakers in the mid-cap market. I mean, we're talking about obviously these defense stocks and PSU stocks. United Spirits is up about 35-36% in the last 1 year. Okay, let's talk about one more stock that's in focus right now, and that's Nalco. Nalco is up, but it's cooled off a little bit from the highest levels of the morning. Let's understand how that quarterly report card looked. Nigel, what's your verdict?
Well, the stock is actually at a 52-week high, so that could be one of the probable reasons why it's come off a little bit from the day's top, but no worries with the numbers. They looked good. On the top line, there was a small miss, though, because the alumina sales, in all likelihood, was a little bit lower than what the street was working with. However, the EBITDA number is something that looked really, really good. It's the best ever numbers that we've seen all the way since the March 2022 quarter. So those numbers look good. In absolute terms, it came at around 1,100 crores. We were working with a number of around 950 crores out. So that was the beat. What helped them in the past quarter? Well, clearly, expenses were on the lower side. So the other expenditure was much lower on a year-on-year basis. And the good news is the power and fuel cost as well was much lower, which is heartening, which tells you that they're getting a high amount of coal from captive sources. For the past year, the total amount of coal that was mined for the captive users was close to around 2 million tons. Now, in terms of their segmental breakup, well, the alumina business, which is termed as the chemicals business, that did very, very well because the EBITDA for the quarter came in at more than 500 crores. While the aluminium business, well, it was more or less a flattish number. Now, going ahead, things will improve because aluminium prices are higher. And the cost of coal as well will come down because they'll get a high amount of their coal from captive sources. So these numbers look good. However, the stock has come off maybe some profit taking after it's rallied a goodish bit and it's trading near 52-week highs. Back to you.
Okay, well, yeah, absolutely. That would make perfect sense given this huge rally that we've seen in most base metal stocks, Nalco included. Thank you very much, Mangalam and Nigel, for that. Let's move on and focus on one more. We are now looking at Borosil Renewables. Now, here the numbers seem a little patchy for the fourth quarter. Again, it's a result review. We've got Vivek joining in. Vivek, big fall in profits. What's happening?
Well, it's been a year of pain as far as Borosil Renewables is concerned. The management has been alluding to multiple factors that have gone ahead and impacted the performance, and this has nothing to do with the kind of demand that the industry is seeing. First, let's have a look at the Q4 performance itself. Number one, revenues down 8% on a year-on-year basis. What impacted their revenues? Number one, as far as the domestic market was concerned, a lot of demand, but the fact is that there is oversupply due to Chinese dumping, and on the back of that, prices are much lower. So price realization is much lower, leading to top line decline in the domestic market. Now, talking about the exports market, company has said that demand as far as the European operations was quite low this time around, and that also impacted the top line. On the back of that operational performance this time around, operational loss of over 25.5 crore versus an operational profit last year of 34 crore. And on the back of that, the company also declared a loss on the bottom line of close to 53 crore. Now, looking at the prices at which, the solar grade silicon are currently trading at, it's dropped 80% on a year-on-year basis, coming to a low of almost 10.3 cents per watt as far as May 15th was concerned. Going forward, number one, the company is going ahead and looking to raise close to 750 crore via rights issue. This will be to go ahead and reduce the debt. And along with that, any imposition of ALMM is something that could, buoy the prospects of the company going forward.
Okay, let's move on then. Sumitomo Chemical is one of the big movers. It's up over 6% on the back of its Q4 numbers. Vamakshi joins in with the details. Vamakshi.
Well, Rima, a strong set coming in from Sumitomo in an otherwise quarter which was otherwise affected by macros. When we look at the revenue, that has come in nearly 4% above what the street was expecting at 674 crores. The operational performance for the company was also much better as compared to expectations, and in fact we saw a spike of almost 1,000 basis points in the gross margins. Gross margins have come in at almost 41.75%, and the management says that the improvement in gross margins is largely being led by procurement efficiencies for inputs, optimum pricing strategies, as well as cost control measures for fixed direct overheads. When we look at the EBITDA as well, that is seeing an uptick of almost 74% on a YOY basis, and this has come in nearly 39% higher than what the street was expecting. The EBITDA margin too has come in nearly 530 basis points above the street's expectations. The net profit stands at 110 odd crores for the company. This is seeing an uptick of almost 52% 9%, and this compared to the estimates is an uptick of almost 37%. So very strong show from Sumitomo is what I would say. They've also managed to reduce the net working capital days by almost 33 days, and in fact they've also announced capex plans. They will be buying 2 additional land parcels. The transfer process is expected to be completed soon. They have a regular capex of around 70 to 75 crores, and they are putting in additional capex of almost 120 crores over the next 2 years for 5 products, and the revenue potential from these 5 products is expected to be anywhere between 200 to 250 crores per annum. So overall, a strong show coming in from Sumitomo as far as the operational performance is concerned, and as a result, the stock is surging in trade today.
Okay, all right, got that. Vamakshi, thank you very much for the details. Well, on that note, we are going to take a very quick break. Come back on the other side. When we come back, market regulator SEBI has released an updated SOP, Standard Operating Procedure, for additional disclosures by FPIs. Now, what is this all about? We'll discuss it with Puneet Shah of Dhruva Advisors. Welcome back. You're with us on Trading Hour. Now we're looking at an issue which seems very technical and perhaps minor, but is it potentially something big that the market will have to grapple with when it comes to foreign portfolio investors? Now, depository participants as well as custodian banks have come out with new SOPs, Standard Operating Procedures, which will govern whether FPIs should get exemption from enhanced disclosure requirements that kicked in from April of 2023. And this happened in the midst of the whole Adani saga when SEBI had tightened disclosure norms, and it had made more granular disclosures mandatory if 2 conditions were being met by any particular FPI. Whether the first of that condition was if that FPI is owning more than 50% or more than 50% of its assets are going in one single Indian company. And the second condition was if the FPI's aggregate investments in the Indian capital market are in excess of 25,000 crore rupees. So if those conditions were being met, you had to comply with granular disclosures unless you enjoyed exemptions on certain bases. Now that criteria for exemptions has been tightened. So just very, very quickly, what is the new criteria? Now in very, very clearly laid out terminology, the new norms say or seem to suggest that for pooled investment vehicles, how to determine whether these are widely pooled investment vehicles or not, the contributors to that FPI, to that fund, they must enjoy equal rights, pari passu rights. Then there should be no segregated portfolios maintained. I mean, a different class of investors should not get different rights in different portfolios. And then the investors themselves, the contributors to that fund, they should not be owning the fund and operating that fund. There should be distinction between the contributions coming in from contributors and the management of that FPI structure or that FPI fund. So these are some of the new, very clear distinctions that have come out. The question is this going to impact the market in any way whatsoever? We have Puneet Shah of Dhruva Advisors joining in. Puneet, thanks for joining in. Technical issue. Your first thoughts.
I think it's a very interesting development. The circular or the SOP always existed. It came in last year, as you mentioned, Surbhi. And however, it was subjective. It was depending on DDPs, it was depending on custodians to decide which of the FPIs would be exempted from the disclosure norms. And I think there was a need to tighten some of these criteria and make it more objective. So what the new SOPs, I think, has been agreed by the custodians or DDPs along in consultation with SEBI is that let's make this criteria more objective and very specific as to which are the FPIs which would be exempt from the disclosure norms. And as you rightly mentioned, the criteria are, they have to be regulated in the home jurisdiction by the appropriate regulator. The unit holders have to have pari passu rights. I think that is something which is new and very apt, because if the particular class of investors, if they have a disproportionate rights or disproportionate economic interest, in that case, they are able to control the downstream investments. But here, one of the requirement, the key requirement is that the contributors to the fund they enjoy pari passu rights. So nobody has any higher rights, no one has any lower rights. That is number one. And number two, the investors in the fund or FPI do not control the ultimate investments being made by the FPI. They do not control the investment manager, which is controlling the FPI. These two, as I can see, are the key additional criteria which help DDPs and custodians to appropriately monitor the FPIs, their independence, and providing them the exemption from the granular disclosure norms.
Puneet, to try and sort of simplify this even further, can this impact a lot of FPIs? I mean, the big FPI structures that are investing in the Indian market, could they be in breach of these conditions, which is giving all investors equal status, pari passu status, not having any kind of segregated portfolios, and there being a clear separation between the contributors into that FPI fund and the manager of that FPI fund? Could there be a breach, in which case exemption won't be given?
That's correct. That's correct. So I think the new criteria look to me quite objective, quite specific, and to my mind, I think it would be very difficult for the FPIs or the managers or the contributors to breach these criteria because this has to be governed by the regulator, home regulator, or the constitution document of that jurisdiction. And once it is provided in those documents, then the FPIs will have to follow these norms. And therefore, if they breach these norms, then clearly they will not be exempted. And they have been given 3 months of time frame up to August 24 to comply with these regulations, new regulations or new SOP. If they do not comply with these new regulations, then clearly they have 1 more month to wind down their position or liquidate the position. So these are quite stricter norms in that sense. So that is number one. Also to add, there is Annexure D, as I can see in the regulation, which was quite an exhaustive list earlier. Annexure D talks about the jurisdictions, the examples of jurisdictions they have given from where these FPIs could invest in India and they could be subject to this exemption from the disclosure norms. That list seems to be substantially truncated. The new list only contains jurisdictions such as USA or Australia. It doesn't contain the very popular jurisdictions such as Mauritius or Singapore or Luxembourg for that matter. Not sure whether this is intended or this is just an illustrative list, but some of these pooled vehicles in some of these jurisdictions such as Mauritius or Singapore, they do have variable capital or variable class of shares which they issue to the investors. And now that variable class of shares is now prohibited. They have to be pari passu. And therefore, is it intended that these jurisdictions are no longer mentioned in the annexure, or is it just an illustrative list? That needs to be clarified. But overall, there seems to be quite a tightening of the norms, making it quite objective, and therefore, to my mind, it would be quite important for the FPIs and the DDPs to follow these norms going forward basis.
So, in your assessment, Puneet, what is going to be the market impact? You've explained various aspects of it, but will this be disruptive to your mind?
We'll have to wait and watch. I'm just going through the conditions again. Clearly, it would depend. It's a very case-specific thing. We have seen several FPIs who have different class of units which are being issued to the different investors who have different economic interest, who have different controlling rights. There are disproportionate returns being paid to the investors. There could be segregated portfolio for several investors as well. So yes, we have seen in our real practice FPIs with differential rights given to the investors, given to the contributors. And those FPIs going forward will not qualify. Of course, they have to also meet overall condition of the more than 50% of the AUM in India, 25,000 crore limit. All those limits also have to be satisfied to fall within these SOPs. But if they qualify for those criteria and they do not have these conditions, then I think it could be to my mind disruptive for the market, because numbers involved would be pretty large, because it applies only to certain.
Puneet, that is the biggest question, right? And the thing is, when these enhanced disclosure norms were released last year, in August last year, there was this big hue and cry about whether there will be a lot of market disruption. But thanks to the exemptions, it wasn't a big market event, because a lot of the structures, I guess, got the exemption. Do you feel that now in this new form, with these new exemptions, there could be a risk of disruption?
Yes, I was just comparing the exemption norms which were issued last year, August 23, vis-a-vis the disclosure norms today. And I do see significant tightening of the disclosure or other exemption norms. Earlier, a lot of subjectivity given to DDPs and the custodians, even though there was a guiding criteria which was already given to say that common portfolios for all the investors. That was the no segregation. That was a guiding principle last year. Today, that guiding principle continues. Plus, you have additional criteria, especially on this pari passu rights in the entity, which I would say is a very significant amendment, very significant measure with the SEBI and custodians have taken. And to my mind, it could have a significant impact.
Okay, understood. Thanks very much, Puneet. I think we'll have some more discussions on this to figure out how it plays out. The cutoff now date is the 20th of August, by which either you have to comply with these new rules or disclose your beneficial owners or start winding down. Got it. Thank you very much for taking us through this new development with respect to FPI disclosure norms in the country. And with that, we're coming down to the end of this edition of Trading Hour as well. And Rima, I mean, as we're closing down, not only has the Nifty cooled off, but the mid-cap market, now that's looking at a bit of a sell-off.
Oh, absolutely. The mid-cap index is down close to about 0.7%. The small-cap index, too, has a cut of about 0.6%. And look at the advanced decline ratio. It was 2:3, and now it's 1:2. The gap between the two has widened. But with that, we're going to wind down on Trading Hour from the entire team. Thank you for watching.